Hello everyone, welcome to this month's market update. I'm Tyson Romanick, Senior Portfolio Manager here at Baker Boyer, and I hope you all had a great New Year's. The markets had a really good year in 2025, so we had a good year last year as well. Not surprisingly, these great returns have led a lot of people to ask, are we in a bubble right now? Mainly because we've seen three consecutive years of great double-digit returns. And so that's really leading people to ask the question, is next year, or I guess this year, going to be a down year? And the honest answer is markets don't work on a schedule. But looking back to history, going back to 1960, in any one year, markets are usually up 75% of the time. But if we want to kind of narrow it down to more of the situation we're in now, if you look back, to the 60s, the markets have had 18 times where they've been up 3 years in a row. So the question is what, historically has happened in that fourth year? And the answer is markets were up 9 out of those 18 times. So about a 50-50% chance. So all this shows is just because markets have been up 3 years in a row doesn't necessarily mean the next year is going to be a bad year. So the next question is, well, can markets still go up from here with this AI, enthusiasm, and that's kind of where we have to start to look at valuations. So looking at PE ratios, which is just how expensive the stock market is, how much we're willing to pay for a company's earnings. Historically, they are on the higher side. So this is something to be cautionary about. And so we are following that very closely. But on the good side, or the encouraging side, is this rally has improved the quality of it over time. So if we go back to 2023 and look at the great year we had, most of that return just came from multiple expansion, which just means that people were paying more for the same amount of earnings. Now going to 2024, it was a little better. It was more balanced. So, half of the return came from people paying up for those same earnings, but then earnings also grew. So that was a little bit more balanced. But then looking at 2025, the bulk of the returns came from earnings growth. And that's the kind of foundation, you want to build off of, because it's not prices are just going up because sentiment's hot. It's prices are going up because companies are actually making more money. We've also seen markets broaden out, which kind of, helps address the other big question is, are those Mag 7 stocks overpriced and going to cause a market collapse? And in 2023, the Mag 7 stocks drove most of the returns, and kind of same story in 2024. But if you look at last year, that rally broadened out, which is a good thing. And so the returns were a lot more evenly distributed. So it wasn't just those Mag 7 stocks, driving things. So if you weren't even invested in those Mag 7 stocks, you still would have been up over 13%, which is great return in any year. So you can see this in this performance dispersion chart that we have up here. So looking back at 2023, you can see all Mag 7 names, and then the far right bar is the overall index, and you can see 2023, those Mag 7 stocks just crushed the index. And then if you look at 2024, they aren't up as high, but all but one Mag 7 stock still beat the market. But then if you look at last year, only 2 of those 7 names beat the market, and they weren't running away with it. So this just shows that market participants are being a little bit more selective in what they choose. Valuations do matter. And this market's broadening out. Other areas like financials, industrials, infrastructure, even utilities had great double digits years. And so that's really showing that this market has a solid foundation. Same thing is happening with earnings too. So those Mag 7 stocks, in 2023, they had monster earning year. But since then, how fast their earnings are growing has been slowly coming down. And then on the other hand, if you look at the other 493 names, their earnings are actually growing. And this is important because that's what the market pays for, is those long-term earnings growth. One final point I'll just throw in there is, this isn't just a U.S. story. International markets had a fantastic year. They doubled what we did here in the U.S. So that just shows why it's important to stay diversified. And even though they had such a great year, they still look really cheap historically. So we could see this also continuing to run into 2026. So with that, I would say the takeaway is, we are being mindful of valuations because higher valuations can cause sharper pullbacks. But the improvement in fundamentals, earnings growth and kind of the broadening of the market suggests this isn't just a speculation rally. So we think kind of a disciplined, diversified approach, across sectors and regions is really the way to stay invested while also mitigating some of that risk out there. So with that, if you have any other questions, please reach out to your Baker Boyer representatives, and we'll see you next time.